picture. This. Your credit card statement shows $2,000. You think it's manageable. Then you see the interest line, hundreds a year at 23%. Meanwhile, national credit card debt just hit $1.23 trillion. That big number isn't abstract. It's showing up in your wallet right now. Most people grow up hearing one money rule repeated like gospel. Debt is bad. Pay it off as fast as you can. Emotionally, that feels right. You owe something. You eliminate it. You feel free. But in 2026, that rule followed blindly is quietly costing a lot of people real money. Not because debt suddenly became good, but because inflation, opportunity cost, and fixed-rate math changed the game. And most people never updated their strategy. Here's the uncomfortable truth. Not all debt is equally dangerous. And in an inflationary environment, rushing to pay off low interest, fixed-rate debt can actually slow your financial progress instead of speeding it up. As of early 2026, inflation has cooled from its peak but remains persistent. Hovering in the low to mid-single digits depending on the measure, many high-yield savings accounts still pay roughly 4 to 4.5%. Some long-term investments, historically, have returned more than that over time. Meanwhile, millions of Americans are sitting on fixed-rate debt taken out years ago at rates well below today's inflation. 2. When inflation is higher than your debt's interest rate, the real value of what you owe is shrinking over time. You're paying it back with dollars that are worth less than the dollars you borrowed. That doesn't mean you should ignore the debt. It means the urgency is different, and most people never pause to recalculate. Now, compare to choices. Option 1. You aggressively pay off a 3% fixed-rate loan early. Option 2. You make required payments, but direct extra cash toward an emergency fund, retirement account, or diversified investments. Many experts suggest that when your expected long-term return is higher than the interest rate on the debt, opportunity cost matters. Share. Every extra dollar sent to low-interest debt is a dollar that cannot grow elsewhere. Over years, that gap compounds. Quietly, relentlessly. This is where people get tripped up. Paying off debt feels productive. Investing feels uncertain. But feelings don't change math. And inflation punishes money that stands still. Of course, this does not apply to all debt. Low-interest credit cards, payday loans, and variable rate balances are still financial quicksand. Their rates often exceed inflation by a wide margin. Eliminating those is usually a priority. The mistake happens when people treat a low-rate student loan, auto loan, or mortgage the same way they treat a credit card. They lump all debt together and attack it emotionally instead of strategically. Research shows that the emotional debt-free feeling can lead to missed compound growth, sometimes tens of thousands over decades. Especially when inflation is eating cash faster than low-rate debt is costing you. A better framework many professionals use is simple. Call it the 4-step escape plan. Step 1. Get honest. List every card, balance, APR, minimum payment. Many people discover one card charging 27 to 28%, while another sits at 20%. That alone changes priority. Step 2. Build a buffer. Start a small emergency fund in a high-yield savings account. 4.5% as of early 2026. Enough to keep surprise bills off the card. Even $1,000, $2,000 makes a difference. Step 3. Attack the fire. Throw every extra dollar at the highest rate card while paying minimums on the rest avalanche method. Step 4. Protect the gains once high-rate debt is gone. Redirect that cash to growth, index funds, retirement accounts, or even more high-yield savings. In an inflationary environment, liquidity matters. Flexibility matters. Growth matters. Someone who keeps cash reserves, invests steadily, and manages low-interest debt intelligently may build more real wealth than someone who rushes to zero debt but has no buffer and no growth engine. There's also a risk angle most people miss. Paying off low-interest debt early locks money into an illiquid decision. Cash and investments can be redirected. Extra principal payments usually can't. Nordness means debt is harmless. It means context matters. Inflation changed the rules, but many people are still playing the old game. So the real risk isn't carrying a manageable low-rate balance. The real risk is sacrificing long-term purchasing power, because being debt-free feels safer than it actually is. The question to sit with is this: are you making decisions based on math and long-term outcomes, or based on rules that made sense in a very different economy? This video is for education and general information only. It is not personal financial advice and not a recommendation for your specific situation. Everyone's finances, goals, and risks are different. So do your own research or speak with a qualified financial professional you trust.